Hello viewers, welcome to my channel. I am Hashim Ali Khan. So in this video I am continuing the discussion on depreciation. The provisions for depreciation under Income Tax Act 1961 and what is the meaning of the term actual cost, written down value WDV and unabsorbed depreciation. These are the topics I am going to discuss in this video. Already first video I have prepared. In that first video I have explained you the meaning of the term depreciation and what are the provisions for calculating depreciation according to provisions of Income Tax Act, and thirdly what are the different rates of depreciation on different blocks. So Income Tax Act 1961 says depreciation should not be calculated on individual assets. All the assets should be grouped. So that group of assets is called block of assets. The meaning of block of assets: a group of assets of the same nature and same rate of depreciation. Same nature and same rate of depreciation are grouped together, that is called block. So Income Tax Act has specified what are the different rates of depreciation for different blocks. Already I have explained in detail in the first video. So if you have not watched that video, go to the playlist of my channel, select the subject Advanced Aspect of Income Tax. First video you watch, definitely you can be able to get the complete provisions of depreciation. So before starting this video, I want you to take a screenshot of the notes which I have written on the board so that you can make a hard copy, you can write the notes permanently, it will be available to you before examination. Apart from that, one more channel I have started on YouTube by name Khan's Accounting Institute. Again I repeat, Khan's Accounting Institute. This channel I have prepared mainly for IGCSE students. So those who are pursuing IGCSE courses, they can go to this channel, watch the videos, and don't forget to subscribe that channel too, as you have subscribed this channel. That will be meant only for IGCSE students. Take a screenshot, then I'll explain the depreciation. Come on viewers, now what are the main points, important points for calculating depreciation according to Income Tax Act. First point, if a newly purchased asset is used for less than 180 days, then depreciation is allowed at the rate of 50% of normal depreciation. For the newly purchased asset, the period of usage is calculated from the date of purchase or the date of an asset put to use to 31st March 2021. Current assessment year is 21-22. 21-22 is the current assessment year. The previous year is 2021. 2021 is the previous year. The last date of the previous year is 31st March 2021. This is the last day of the previous year, right? So what this provision says, if a newly asset is purchased and the use of the asset is less than 180 days during the first year, very first year. The first year is from 1st April 2020 to 31st March 2021. Our previous year is 1st April 2020 to 31st March 2021. During this year, if an asset is purchased and used for less than 180 days, then Income Tax Act says depreciation is 50% of normal depreciation. 50% of normal depreciation. Example, a machine is purchased. The value of the machine is suppose 1 lakh. 1 lakh rupees is the value of the machine purchased during the year, during the previous year, first time. So 1 lakh is the purchase price on which 15% is the rate of debt. Suppose so 15% of 1 lakh is 15,000. The normal depreciation is 15,000. Suppose if the machine is used for less than 180 days during the previous year, then 50% of 15,000. 50% of 15,000, it comes to 7,500. The first year depreciation will be taken 7,500. That is the provision. First one. Second one, note, if an asset is not used at all, no depreciation is allowed in the first year, and the same provision is applicable in subsequent year. Income Tax Act says if you want to claim depreciation, the asset must be used. If the asset is not at all used, no depreciation will be allowed in the first year and also in the subsequent years. If in any year the asset is not at all used, no depreciation will be allowed. Next one is to calculate depreciation on this asset that is used for less than 180 days. It is not to be included in the block of any of the asset. That is, a separate block should be made. When an asset is purchased first time and it is used less than 180 days, then this asset should not be included in any other block. A separate block will be opened for that asset which is newly purchased and used less than 180 days. So this new asset should not be included in any other asset, in any other block, if it is used for less than 180 days. If it is used for more than 180 days, full depreciation will be allowed and it will be included in the other blocks. That is the provision. Next is, in the subsequent year, if the asset is put to use for less than 180 days, even then full depreciation is allowed. This provision of 180 days will be applicable only for the first year, only during the first year of purchase. In the subsequent years, if the use of the asset is less than 180 days also, full depreciation will be allowed, not 50%. This 50% rule is applied only during the first year of purchase. Subsequent years, if it is used even for less than 180 or more than 180, full depreciation will be allowed. If in the year of purchase, if the asset is not put to use, but in the subsequent year, if it is used for less than 180 days, depreciation is allowed fully. Suppose an asset is purchased. During the first year, it was not at all used. When not at all used means no depreciation is available during the first year. Now in the second year, subsequent year, if the asset is used even for less than 180 days, full depreciation will be allowed, not 50%. Full depreciation will be allowed in the subsequent years, right? Next, if any asset is sold out or discarded or demolished or destroyed, the difference between the WDV, written down value, and the sale price or insurance claim received will be treated as short-term capital gain or loss. Suppose during the current year, one of the asset was sold, one of the asset was discarded or demolished or destroyed. In that case, no depreciation will be charged in that year. Now the difference between the WDV and the sale price, the difference between the sale price and WDV will be treated as short-term capital gain or loss. Example, a business is having machine whose WDV is 50,000 rupees. 50,000 rupees is the WDV, written down value, and it was sold for 60,000. Sale price 60,000. Now Income Tax Act says no depreciation should be provided on this machine which is sold. The difference between the sale price and WDV will be treated as short-term capital gain. 60,000 is the sale price and 50,000 rupees is the WDV. The difference 10,000 is the short-term capital gain. Suppose if it is opposite, 60,000 WDV and 50,000 is the sale price, then 10,000 rupees is the short-term capital loss. That is the provision. Next one, any asset remains idle due to power cut, strike or lockout, and the asset is used for less than 180 days, even then depreciation is allowed fully. Suppose if during a current year the asset was not used for more than 180 days, it is used for less than 180 days. Why? The reason may be strike, the reason may be lockout, the reason may be power cut. Due to abnormal reasons, the machine was used for less than 180 days. In that case, full depreciation will be allowed for 1 year. right? Only in one case it is allowed 50%, when if a newly purchased asset is used in the first year for less than 180 days, then 50% normal depreciation. That's all. So these are the provisions you have to remember while doing the problems. All these points will arise. So you must be in a position to remember that these are the provisions of Income Tax Act 1961 regarding depreciation. Now another question will be asked in examination, like what do you mean by actual cost? Because depreciation will be calculated on cost. First year it will be calculated on cost. Second year onwards it will be calculated on WDV, written down value. So first year it will be calculated on cost. So what do you mean by actual cost? Here I am explaining, very frequently in examination they will ask. So actual cost of the asset means the amount paid for purchasing the asset, and it also includes all expenses incurred in connection with the purchase. That means actual cost means the purchase price of the asset, and it includes all incidental expenses related to purchasing. Related to purchasing the asset, all incidental expenses should also be included. Example. Here I have given the example, that is expenses incurred till its first use. Example, brokerage paid, erection charges, etc., and excludes any grants or subsidy received. Sometimes the government will give some grant, some subsidy. So grant and subsidy should be deducted from the actual cost. For example, in our business we have purchased a machine for 10 lakh. For 10 lakh we have purchased the machine, but the government has given a subsidy, a grant of 1 lakh rupees on this machine. Because machine is, suppose, very important machine, it is life-saving machine, so government will give the grant. So out of 10 lakh, 1 lakh rupees subsidy we are getting from the government, deduct that. Remaining 9 lakh. On that 9 lakh, all incidental expenses like brokerage paid to purchase the machine, or freight charges paid, or erection charges paid, these should be added. This should be added to the cost of the machine. So practically how to calculate the actual cost of machine? Here I have shown total cost price of the asset. We'll take first of all the purchase price, cost of the asset. From this we deduct subsidy received, if any. Sometimes the assessee will receive the subsidy or grant from the government. If it is there, it will be deducted. Then add expenses incurred on acquiring the asset. On purchasing the asset, some freight charges are incurred, some insurance charges are incurred, some brokerage is paid. All these are incidental expenses. Freight, insurance, brokerage, etc. These will be added. Then add installation or erection charges. After purchasing the machine, some technical people will erect the machine. So erection charges should be incurred. That will also be added. Then add interest paid on amount borrowed to purchase the asset. Sometimes a loan is taken to purchase the asset, and on that loan interest is paid. That interest will also be included in the cost if the interest is paid up to the date when the asset is first put to use. After putting it to use, the interest will not be included. Before putting it to use, whatever interest is paid, that will be included. For example, we have taken a loan from bank on 1st January for rupees 10 lakh for purchasing the machine. By the time we purchase the machine, install the machine, 3 months are over. From 1st January to 31st March. On 31st March, the machine was installed and put to use. That means how many months are there? 3 months are over since we have taken the loan from bank. We have taken the loan from bank on 1st Jan, and the machine is put to use on 31st March. So interest charges from 1st Jan to 31st March. These 3 months interest charges will also be included in the cost of the machine. Then interest paid. Then we'll get the actual cost. So this is the procedure of calculating the actual cost of the asset. The next topic is written down value, WDV, short form it is called. Income Tax Act says depreciation should always be calculated according to written down value method. There are different methods of calculating depreciation. You might have studied in accounting subject. Straight line method, reducing balance or WDV method, insurance policy method, sinking fund method, replacement method. So many methods of depreciation are there. But Income Tax Act says we will allow depreciation only on WDV, except a few assets on which straight line method is allowed. Only few. But regarding normally all the assets, depreciation will be calculated according to written down value. So here depreciation is always calculated on the closing WDV. Closing means end of the year. End of the year, whatever is the WDV of the asset, on that WDV of asset, depreciation will be calculated. For calculating the closing WDV, the following method is suggested. How to calculate the closing WDV? See here. Opening balance of WDV. First we take opening balance of written down value, beginning of the year. To this we add purchase of assets during the year. If any asset is purchased during the year in this block, that asset will be added. Less sale of asset during the year. If in this block any asset is sold, so whatever is the sale price, that sale price will deduct. Then we'll get the closing WDV or written down value at the end of it. Simply take the opening WDV, add purchase of asset during the year minus sale of the asset during the year, we'll get the closing WDV. On this closing WDV, we will calculate the depreciation for the current year. Next one, plant. Plant includes machinery, vehicle, books, ships, surgical equipment, etc. So this plant, according to Income Tax Act 1961, plant includes machinery. Machinery is also called the plant. Vehicle also comes under the category of plant. Books also comes under the category of plant. Ships or any equipment. All these things will come under the category of plant according to Income Tax Act provisions. Now, unabsorbed depreciation. Unabsorbed depreciation, meaning the depreciation which is not absorbed in the revenue account. If the business profits are not sufficient to deduct the depreciation, then the difference between the two amount is known as unabsorbed depreciation. Example, a business is having the total sales are 10 lakh and the total expenditure, the total expenses excluding depreciation is 8 lakh. Suppose 8 lakh. So 10 lakh rupees are the revenue, sales revenue, 8 lakh rupees are the expenses. So 10 lakh minus 8 lakh, 2 lakh rupees are the profit before depreciation. Profit before depreciation 2 lakh. Now suppose the depreciation during the current year is 3 lakh rupees. 3 lakh rupees is the depreciation, but the profit available is only 2 lakh. That means all the depreciation cannot be absorbed because depreciation is 3 lakh, but the profit available is only 2 lakh. So 1 lakh rupees is called unabsorbed depreciation. 1 lakh rupees is called unabsorbed depreciation. Now, unabsorbed depreciation can be carried forward indefinitely and can be set off from the profits and gains of subsequent years. The Income Tax Act says if any unabsorbed depreciation is there, it can be carried forward to the next year and can be set off from the profits and gains of business and profession in the next year. Again, if it is not there, if the profit is not sufficient, it can be carried over to again next year indefinitely. There is no time period. So unabsorbed depreciation, if it is not absorbed during the current year, it will be carried forward to the next year. Next year it can be deducted from, it can be charged from profits and gains of business and profession. If there is no profit, again it will be carried over, like that indefinitely we can be able to carry over until and unless it is set off. Now, The following points should be considered while charging depreciation under the heads profits and gains of business and profession. So what are the points regarding this unabsorbed depreciation according to provisions of Income Tax Act? First one, the unabsorbed depreciation loss of one business can be set off from the profits of another business in the same previous year. The first rule given by Income Tax Act is, if a person is having two businesses, one suppose textile manufacturing business, another cement manufacturing business. Textile and cement, these are the two separate businesses, same assessee is having. Suppose if there is unabsorbed depreciation in textile, that unabsorbed depreciation of textile can be set off from the profit of cement business. Usi tarah, in the same way, if there is a unabsorbed depreciation in cement business, that unabsorbed depreciation of cement business can be set off from the profit of textile business. That means if two or more than two businesses an assessee is having, he can set off the unabsorbed depreciation of one business with another business. That is the first point. So we have discussed about the unabsorbed depreciation. First point, the unabsorbed depreciation loss of one business can be set off from the profit of another business in the same previous year. I told you, if a businessman is having two or more than two businesses, then one business unabsorbed depreciation can be set off from the profit of the another business in the same previous year. First point. Now the second point is the continuation. The second point is, if unabsorbed depreciation loss is there, then it is deductible from other heads of income except income from salary and casual income in the same previous year. Suppose Income Tax Act says, if there is unabsorbed depreciation in a business and that unabsorbed depreciation can be set off from any other income in the same previous year except income from salary and casual income. Excepting this income from salary and casual income, other incomes, that means the unabsorbed depreciation can be deducted from other incomes. The other incomes like income from house property or income from capital gain or other sources. If other heads of incomes are there, the unabsorbed depreciation can be set off from the other heads in the same previous year. The next one is, if still unabsorbed depreciation is there, it can be carried forward to the subsequent years without any time limit and can be set off from income of all heads except income from salary and casual income. Again, Income Tax Act has given the provision that if we don't have any other income during the current previous year, then the unabsorbed depreciation can be carried forward to the next assessment year, next previous year. Like this, the unabsorbed depreciation can be carried forward for any number of years indefinitely. And in the next year again, it can be set off from income from business or any other income except income from salary and casual income. Leaving these two, income from salary and casual income, from any other income, the unabsorbed depreciation can be set off in the subsequent years. Now, in the year of set off, the current year depreciation and unabsorbed depreciation can be given as deduction to the extent of profit available. So when we are calculating the profit of a business, we deduct the current year depreciation and unabsorbed depreciation of the previous year to the extent of profit available. Example, during the current previous year, the profit available is 1,50,000. 1,50,000. This is the profit available before depreciation. From that 1,50,000, first deduct current year depreciation. Suppose current year depreciation is 1 lakh. So from 1,50,000 profit, deduct 1 lakh rupees depreciation of the current year. Now remaining profit is 50,000. Now from that 50,000 profit after depreciation, deduct the unabsorbed depreciation of the last year. If last year unabsorbed depreciation is brought forward, that then unabsorbed depreciation of last year will be deducted. Suppose last year unabsorbed depreciation was 75,000, but the profit available here is only 50,000. So 50,000 will be set off. Remaining 25,000 unabsorbed depreciation will be carried forward to the next year, like that. Next one is, if there is a business profit if there is a business profit before charging depreciation, then the order of set off is as follows. Current year, if there is a business profit, so how we set off? What is the order of set off? So here Income Tax Act has given current year business loss. First we deduct current year business loss. Any other business if he is having two or more than two businesses, so A business he is having profit, B business he is having loss. So loss of B business can be set off from the profit of A business. Secondly, current year depreciation. Whatever current year depreciation is there, that will be deducted. Then unabsorbed business loss of the earlier period. If there is unabsorbed business loss of the last year, that will be deducted. Then unabsorbed depreciation of earlier period. The unabsorbed depreciation of the last year will be deducted. Like that, this is the order of set off if we have unabsorbed depreciation of the last year. That's all. So this is the end of the discussion on the topic depreciation. Theoretical part I have completed. Now we have to do the practical problems on valuation of stock and depreciation. That will take up, inshallah, I will take up in the next video. So keep watching, gain the knowledge, be confident on this subject of income tax. Remember, whatever theory I have explained, if you watch with full concentration, easily you can understand the problems. If you have not watched this theory directly, if you go to problems, definitely you will find it more difficult. So watch these theory videos twice, thrice. Then only easily you can solve, answer the problems on depreciation. Inshallah, we'll take up in the next video.